Hey folks, are we seeing a reset? Is the mood changing? Are people losing hope? We're going to cover a bit of this and talk about how home ownership is softening out there and what we're experiencing. And we're going to take your questions and discuss a few things on this episode 182 of the Wise Old Owl podcast, Ruffle Feathers. We're going to switch the name in a little bit, but thanks for tuning in. I'm Vince Gaetano. There has been a mood that has been lingering over the last couple weeks, and it hasn't been good. A lot of people are losing hope. A lot of people talking about leaving Canada. A lot of people not realizing that maybe they're realizing that this may not be the place they want to be. And I don't know if this capital gains issue was the straw that broke the camel's back or not, but it just seems that folks are not happy. Everybody's mad, sad, angry, and I think people are going to start to revolt a little bit. I think people are starting to get more cynical about what government's doing, all levels, provincial, municipal, federal. I think people are just tired. People are just not enjoying themselves. And we're going to delve a little bit into some of these stats that I came across this week. We had a launch of our new real estate property management franchise, RPM Wealth Builders, this week. And we had a great speaker. Most of you know him. Daniel Foch came out and did a market update. And he brought out some really interesting stats. And one of them is home ownership rates in Canada. And we're starting to see a shift of that number decreasing. Less people are owning homes than ever before. And as much as we have more and more people coming to the country, we've seen a significant drop in the data of home ownership rates across the country. To give you some perspective, in 2011, we were sitting at about 69%. 2021, and that's the last figure he had on the chart, we're sitting at about 66%, almost a 4% drop. And places that were most impacted were Ontario and BC, where rates have dropped upwards of about 4%, carrying the momentum of the country. But it's really interesting to see that drop because we're seeing more and more people renting. And that is, of course, because of the affordability crisis and whatnot. But everybody's anticipation of rates coming down early this year didn't materialize, and I think people are exhausted waiting. I think we have a meeting in June, and there's another anticipation of a rate drop. I'm not as optimistic that it's going to happen, but the reality is we're starting to see people struggle, more people really have difficulty making ends meet. And we're starting to see things break. We're starting to see deals fall apart. We're starting to see people at renewal scrambling to figure out what to do. And that mood over the last couple weeks has been really at its height. I've never seen it this bad. We are busy. We are busy dealing with situations that involve more trouble. Beacon scores, I saw one of the lowest Beacon scores in a while at 447. People's debt load is increasing. When we're pulling credit bureaus, their utilization rate, that's the amount of debt they're carrying relative to the amount of limits they have, is going upwards in the 80-85% range. So what's happening is we're not necessarily seeing delinquency on the mortgage front yet because it's still relatively low in the grand scheme of things. But people are accessing different credit cards and lines of credits to make their mortgage payments, because Canadians do make their mortgage payments. That's one thing that I want to make clear. Canadians are very responsible. They need a roof over their head. They can always protect that asset. But we are seeing signs of the cracks. We are seeing credit scores come in a little bit lower, utilization rates up, as I said, and people starting to run out of credit. And I think this doesn't bode well. We're seeing increases in listings. There seems to be a flight people from investment properties, especially the condos that are negative cash flow. They probably just did their taxes, saw how much they had to carry over the last year in negative cash flow, and probably don't want to do it again for another year. So we're starting to see an increase in condos up for sale. We're seeing an increase in listings per se. Now, some could say, well, there's a rush for people to sell their secondary units before June 24th because on the 25th, the new capital gains inclusion rate from 50% to 66.7 kicks in. So people are trying to avoid that increase in tax. But the reality is people can't afford it. These rates are starting to take their toll. As I mentioned in the past, it takes a couple years for rates to really impact people's spending habits, and we're now over 2 years since the initial increases by the Bank of Canada, and we're starting to see things break. We're starting to see hundreds of thousands of people having dealt with their renewals now, seeing the impact of the higher costs. As I pointed out in December, we have 2.2 million mortgages coming up for renewal in 2024 and 2025. We're now almost a quarter of the way through it, being in May, and we're starting to see the impacts of those renewals taking a toll on disposable income and the cost of living constraints that are there. And people are mad. They're sad, they're angry, they're pissed off, and they want change. But what was really interesting in some of the data that Daniel Foch shared at the event was that, families are shrinking. And I don't know if it has to do with cost of living. I don't know if it has to do with affordability of homes. I'm not sure. But one stat that he pointed out was in 1851, the average household had over 12 people in it. And then in 1951, that number dropped to 4. And here we are, decades later, and I think the stat was 2.5 people live in a home today. And that's alarming, right? Because that means a couple has less than one kid. And a lot of people live on their own. So, the family unit is shrinking. And Canada still has the third largest number of square footage per capita in the world, only behind Australia and the US. And I think we got to think things through a little bit more and how much house people really need. And there was one stat that Daniel shared with us, and that is the difference between millennials and boomers. And boomers required about 1,950 square feet, and millennials required about 1,600 square feet. So that's a big difference in square footage. And one of the reasons why is boomers like keeping collectibles, books, photo albums, records, different mementos that they needed to store in rooms and whatnot, whereas millennials just had a tablet. Millennials just had everything on their phone. They didn't need to have records and files and stuff that needed to be stored in space. And there's been an unbelievable shift in space that was required. And I thought it was phenomenal. And he also put out a floor map of a home where he used dots and heat sensors of how many rooms were used in a traditional home. And there were rooms that weren't even used, living rooms, dining rooms, rarely used. And we have to think a little bit through this because we do need smaller spaces. We do need to build smaller homes. And I think it really bodes well into the national housing plan and strategy that the government has put forth. There's some really good clues in there as to where we're going. And high density and conversion and repurposing of single family into multi-units, I believe, is the way to go. And the more and more I thought about that presentation, the more I realized that I think people just need to think things through a little bit differently and change their mindset about how much they need as opposed to what they want. And more folks have to start looking at their budgets that way. I think, as I stressed on many episodes, we really got to prepare for what's coming over the next 12 to 18 months as we continue to grind through this quasi-recession. We are in a recession on a GDP per capita basis. We're in negative territory for 6 to 7 quarters. As much as population has driven GDP to that positive number on a per capita basis, we're in the negatives. It's not good. And this is where I think we need to spend more time, all of us who are really dealing with this tight economic environment, is that you got to start focusing on the needs and not the wants. And I encourage folks, go through the last 12 months of your bank statements, print up your last 6 months of your credit card statements. Look at what are those recurring transactions, those subscriptions, those things that you're trying to figure out what they are and can't remember what you subscribe to. Get rid of them. Shed yourself of obligations that you don't need and really think through whether or not you really need them. So, folks, I encourage everybody to take shape of where we are. Things are going to be really tough over the next little while. I don't believe we're going to see a Bank of Canada rate reduction in June. I hope I'm wrong. I really do, but I don't sense it's going to happen in June and could very well be pushed off until July, maybe in the summer. But a quarter point's not going to do much. It's not going to help. It's not going to really impact people. And I think we just got to prepare for a very slow grinding road back to some normalcy. And normalcy is going to look a lot different than what it used to, as much as that sounds a little bit hypocritical. But we are going to see a new norm, and we're going to have to adjust to it. So having said that, really excited about the episode we're going to drop on YouTube in our podcast. I'm really excited about it. So if you haven't subscribed to our YouTube channel at Owl Mortgage, please do so. The Wise Old Owl podcast is dropping another episode this Monday, and you could also hear it on Apple Podcast and Spotify, so tune into that. We're going to get into some Q&As. Why do Canadians love debt? Big homes supporting life through credit cards and HELOCs. Boy, I could go on forever on this question, but the reality is we have run into a society and a lifestyle where you buy now, pay later. And low interest rates gave us that ability to access debt very easily. We've bought more than we can chew because of the low cost to finance this sort of purchasing activity, and it's saddled us with record levels of debt. The average debt load that people are carrying is at its all-time high, and it was a trend that was created of ZIRP, zero interest rate, that we've been grown accustomed to over the last 15, 20 years. So it's over. It's gonna really do some damage for some folks that are not going to be able to keep up with the increase in rates and payments. So, that's not going to end well. Some economists think we'll see a mild recession in 2024. What are your thoughts on that? We're already in one. As far as I'm concerned, we're in a recession. We're going to start seeing more and more job losses. When you're seeing the key months of the construction industry facing folks looking for work, that's not a good sign. So I think we're going to start seeing rounds of layoffs and job losses and insolvencies pop up. I have one of the episodes going to be Doug Hoyes from Hoyes Michelose and Associates. He is a licensed bankruptcy and insolvency trustee. He brings in some really good insight on what we're going to see, and the insolvency and bankruptcy numbers are growing, and it's not looking good. I think we still have a ways to go before it gets resolved. Inventory is going up, homes taking longer to sell. Is it possible a new trend will continue? Absolutely. I think we're definitely seeing a shift into a buyer's market. I think it's very healthy to have a buyer's market because Buyers can then have choice. They could go in with comfort on a deal with conditions, financing conditions, inspection conditions, subject to selling a property if they haven't sold already. And it really gives them an edge to really control their environment and not be rushed into the decision-making process and maybe getting themselves into a situation where they're spending more than they want to with bidding wars and stuff like that. So as we see more and more listings pop up, I think it bodes well for buyers. I think there's going to be opportunity to get good quality property and do so with comfort, ease, and peace of mind, because you could then take your time and go through this process the way it's really intended to be and not be rushed and try to get into that FOMO type philosophy of buying where everybody's rushing you and you're going to then have, doubt and second thoughts about that purchase. They call buyer's remorse. So I think it's good. I think it's healthy. I know realtors and some folks in the space don't think so, but I really believe we got to get back to some normalcy and put things back into the hands of a buyer and make them go through this experience with a little bit more ease and comfort. And I think it's good. I think it's all good. If you currently hold a variable rate mortgage, what should you do? Well, if you've held it on for this long, you might as well just continue to hang on to it. You've stomached the worst of it, and it looks like we may be coming to a very close cut in the near future. Whether it happens in June, July, or the end of the summer, I don't know, but there's definitely going to be a drop on the horizon. And if you waited this long, you might as well wait a little bit longer. So tough it out. Or if you're just sick of it and you need some relief because it's just gotten to the point where you can't handle it anymore, look at competitive 3-year rates. That seems to be the mortgage term of choice right now. No one's really going into 5 years. I can't remember the last 5-year mortgage we did on the fixed rate side, but 3 years seems to be the trend. It's just in the middle of that 5-year too long a term and 1 year is too short, which is at a premium. It seems like many are opting for the 3-year, and maybe that's something you should consider. Have things slowed with interest rate hikes? How is your job different now than say 1 year ago? Okay, well, the market has slowed as far as purchases are concerned. We have been continuously busy with refinances, renewals, investment property purchases, construction loans for people repurposing. We're doing a lot of that right now. But the job has changed. The job has been, I'll be honest with you, difficult. Difficult from the tone and the customer difficulty. Customers are mad, sad, and angry, and we have to show a lot of empathy. We really got to hold their hand and walk them through the different options available to them, and really be sensitive to what they're going through. They're not alone. Many people are going through the same thing, and because it's so personal and sensitive, you really got to spend more time with them to coach them through the different options, understand that they're not alone. And there are options to help them out. Sometimes it is selling and getting out of the home, and that's a difficult option to digest and swallow. So we always tell people to take their time. Listen, we want to try to help everybody, but sometimes there just isn't any good options out there other than to sell and get yourself out of the debt obligation and monthly payment that is just overtaking all your disposable income. And it's all about math. You got to do the math. If the math doesn't make sense, you got to make some tough decisions. And what we try to do is we spend a lot of time going through budgets, understanding what they're spending money on. And as I've told you earlier, it's all about, going through in detail what folks are spending money on. And in a lot of cases, they're surprised at what they're allocating to certain expenses, and getting rid of that, eliminating some recurring costs, saves hundreds and hundreds of dollars that help. So this is what we do. And we're doing it more so now than ever before, and I think that's been the biggest change over the last year. So thank you very much for that question. With affordability concerns, is restructuring your mortgage the solution? Sometimes restructuring is just deferring the inevitable. And I really think that there's got to be an exit strategy. There's got to be an event that makes you want to restructure so that way it acts as a bridge or a band-aid for a short period of time. Trying to restructure for the sake of extending what is a bad situation for a longer period of time is not good. Like, everybody's hopeful that rates are going to drop, values are going to go up, and equity is going to be restored. The reality is that it may not happen as fast as you think it will. And one of the cases I want to bring up is the home I actually live in, okay? I've been living in it for 20 years this past March, and I am the third owner. And during our last big meltdown in 1990, when the market crashed, the peak of the market was when the home that I live in was built, and it sold for over $1 million in 1990. The first buyer purchased it as a new construction by a company called Bramley Limited that went bankrupt, okay? Tribute Homes, Shane Bagay, and I believe another builder bought up all the units and finished them off and sold the rest of the site. The second buyer bought in 1996 for $580,000, which was a significant drop from the original purchase price. And my family bought that home as the third owner in 2004. And we bought it for less than $1 million. And that is a 14-year cycle where it hadn't even got to the original purchase price. Now, I'm not going to suggest that we're in the same environment economically, and it's going to take 14 years for prices to recover from the peak in 2022. But the reality is, it's not going to happen overnight. Like, we've seen almost a 30% drop in real estate values from the peak. And if people are out there leading you to believe that we're going to see a ramp up in values in a short period of time, they're misleading you. Okay? They don't have the data to justify that. And I think you have to look back in time. And I started my career in the mortgage business in 1998 with Canada Trust, and then ended up after a university starting with TD Bank as my first job, full-time job anyways. And I've been doing this a long time, and I'm seeing some similarities. Unemployment hasn't hit the level it was back in those days, but we are seeing similar situations and data points. So, folks, it could take a while. I hope it doesn't, but it could take a long while, and rates were a lot higher back then. Now we have higher debt loads. Rates aren't as high. They're half of where they used to be. Like, back then, the 5-year rate was 10.99, 11%. The 1 year was 14.25, 14.5. So, lot different time. Big difference. But debt loads are considerably higher now, and it's really going to be a challenge. So just be wary. Be wary of the time frame it's going to take. It's going to be a while. Respect the lag and understand that things are going to be difficult for quite some time. I'm going to wrap it up. I want to thank everybody. Please tune in to the episode dropping on Monday on Owl Mortgage YouTube channel, and the Wise Old Owl podcast on Spotify and Apple Podcasts. Thanks again, take care, and enjoy the long weekend.